Okay, good evening. Hope we are all good. Quickly. I've been seeing most of us watching the videos, but likes and subscribing is not coming. Kindly do that for me. I know it wouldn't. I know it would take part of your time though, but kindly sacrifice that time and do it for me. Just like and subscribe if you find this video helpful. Right? Thank you. So basically again. All right. So today we are going to talk about risk and returns. And our main objective for risk and returns is that we want to know how to invest in assets or how we can analyze an investment in assets that will give us a minimum or a small risk but bigger return. So basically, we want to know how we can invest small and then invest, and then our risk will be small, and then will be our returns will be big. That's our main motive for risk and return. Mind you, when this particular topic was taught in class Thursday, I didn't get it just because um, I saw a whole lot of formulas and I gave up. But don't give up. I'm sure that according to how I understood it and how I am coming to explain, I'm sure you will get it from the first onset. But even if you don't get it, kindly rewatch the video again and then add some small research to it. I'm sure you'll be okay. Because for me personally, after class, you know that class is face to face, and after class you won't be able to rewatch any video or anything. So after class, I went on to do further research and stuff, right? Before I came to understand this. So kindly do so. All right, so let's talk. Let's dive into the real business. All right. So risk and returns. We are coming to talk about rate of return, an essential of capital market theory, measuring risk and risk portfolio. So basically, me being a forex trader, I find this topic impactful, like very good for me. This is because I do invest in assets, right? So this session, for example, will help me know how I can be maintaining profits throughout. Because the more you diversify your investments, the lesser risk you get. You get it. So this session, for example, will really equip me, right? And also, for like it's not only about investment, though. It can be practical, as in normal life, right? You know that, let's say, if you're a guy and you have one girl, right? There is a high ability of you getting a heartbreak as compared to when you have many girls. Get it? And the vice versa. If you are a lady and you have one guy, the probability of you getting heartbroken is very high as compared to you getting many boyfriends. Yeah, the same thing. This is what we are coming to do here. So let's go in. So sources of investment. Sources of investment returns. You know, way back in our sessions on bonds and stocks, right? Um, when we invest, right, we either get um, we either get dividends. So okay, normally we have income returns, right, as a source of investment. We also have changes in the price of value. So in bonds, remember that there's what we can gain as coupon, right, which is the interest, and then also capital gains. That is when the bond at the end has matured more than the normal face value, like a premium bond. You get it? So let's say we bought it at a discount, right? And at the end it increased, so meaning we've gotten capital gains. And also S2 has the same thing. We will be receiving dividend and then capital gain if in case the business is doing well and then it grows, right? So both cash flows from an asset and the amount invested in the asset are needed to determine the return on an asset. So returns, we have the dollar return. Dollar return is basically dividend plus change in market value. So dividend plus change in market value is dollar return. So change in market value is basically the price or the price at which you bought the asset and the price you are selling it. So if let's say you bought an asset for 20 and you are selling it for 30, right? If you bought it for 20, you bought it for 20. You bought it for 20. And you are selling it for 30. So the change in market value is the difference between the 30 and 18. So 30 minus 20 is equal to 10. Right. So all right. So when we move on, it can so percentage return is the dollar return, right? This dollar return over the beginning market price, right? So as I use the beginning market price was let's say 20, right? So basically that's it there. And then so now it can be also brought down as the dividend plus the change in market value, which is here, the dollar return. The same thing is what we are seeing, and then over the beginning market value. Then it is also equal to dividend yield plus capital gain yield, right? The same thing, which is the dollar return, percentage return, right? Percentage return is dividend yield plus capital gain yield. So, holding period returns, right? So we first spoke about returns, and we are diving into holding period returns. The holding period return is the return that an investor would get when holding an investment over a period of years, which is the N years. When returns during year I or year 1 is given as RI, so holding period is equal to 1 plus the return in year 1 times 1 plus the return in year 2 times 1 plus the return in year 3 up to the last return. When you are done with multiplying everything, you subtract 1 from it, and then you get your actual holding period returns. So they gave us this example, right? Suppose your investment provides the following returns over 4-year period. So 1 plus the return in year 1, which is 10%, 1 plus the return in year 2, which is negative 5%, 1 plus the return in year 3, which is 1.2%, which is 20%, sorry. Then 1 plus return in year 4, which is 1.15%. So you multiply all of them, I think you get 1.14, 1.4421. Then you subtract 1 from it, then you get your 0.4421. When you turn it to percentages, or when you convert it to percentages, that's when you get 44.2%. So more on average returns. We have basically in this course, I think 2 types of average returns. We have the arithmetic average return and the geometric average return. So arithmetic average returns and in an average period. So return n in an average period over the number of years. Basically like this. It's more like the mean. So let's say year one, you had, let's say, 20%, and year two, you are having, let's say, 10%, and then year three, you're having, let's say, 15%. So you are going to add all and divide it by 3, which is the number of years. So 20, 30, 45 over 3, I think it's 15, right? So 15%. Right? So your arithmetic average means your arithmetic average is 15%. So the geometric also deals with the average compound return per period over multiple periods. So it is more or less like for the geometric, it deals with compounding, right? It is not just the average, but it deals with the compounding of it, right? So basically, for the same in this thing, we had we used, I think, 0.2, and then we used 0.1, then we used 0.15. So 20, 10, and 15 respectively. So the geometric formula looks like the HDR. So it is going to be 1 plus R1 times 1 plus R2 times 1 plus R3, right? There will not be any division over 3. What we are going to do now is we are going to solve for all this, raise the power by 1 over 3, which is the 3 years. Right? If it were to be 4, it will be 1 over 4. If it were to be 5, it will be 1 over 5. And we are done, and then we subtract 1 from it. Right? So let's do that. This will be 1 plus 2% to give us 1.2 times this will give us 1.1 plus times this will give us 1.15. So now this is the power 1 over 3. So when we do this, let's see. So I had 1.518 raised to the power 1 over 3, right, minus 1. So if I will extend it, I'm getting 1.149 minus 1, and I'm getting 0.149. It is almost equal to the 15% that we did the first time. But you see how this is a bit different. All right, so let's move on. So the geometric average will be less than the arithmetic average unless all the returns are equal. So you can just verify this. you can just verify this from here, from what we just did, right? You can see that the arithmetic mean gave us 15%, exactly 15%. But geometric gave us 14 point something percent, right? So you can see that they are telling us, you can see they are telling us that you can see they are telling us that the geometric are equal. So you get it right. Let's move on. So when is better. So the arithmetic average is overly optimistic for long horizon, while the geometric average is overly pessimistic for a short horizon. So now we move on to analyze returns, right? Analyze returns. If we have return or income or price change information over a time period in excess of 1 year, we usually want to analyze the rate of the return in order to facilitate comparison with other investment returns. So analyze HPR. HPR is the holding period returns that we did here. Holding period returns. So what we are going to do is that we add 1 to the HPR given, then it is more or less like the geometric 1 over raised to the power 1 over n minus 1. The same thing, right? So it means that we normally use the geometric. So return computed on an analyzed basis, they are now comparable with all other analyzed returns. So what this basically means is that whenever the returns are given to us in different years, we have to convert them to look like the same, right? So that's what we are coming to do now. So for example, we can look at this. We can look at what we have here, for example. Don't use the HPR percentage. We are using the decimal. If you want to use the HPR percentage, then it will be 100 plus the HPR. But if you want to use this one, it is 100. It's 1 plus HPR. So let me do just 2 and then you try the rest yourself. So if you want to find the analyzed HPR, analyze it, and sorry, return. Right, so analyze the 10 is basically what we get 1 plus HPR here is 8.5, 8.25, sorry. Then raise to the power 1 over the n here is 10 minus 1. So 9.25 over 10. Right, so we can do this and then we are getting 0.2491, which is equivalent to 24.91%. Right. So if we want to also solve for the second one, the second one will be I'm just doing it straight away. 1 plus 90 will be 1.8. 1 plus 0.90 will be 1.9. Right. 1.9 raised to the power 1 over the n here is 4 now. Minus 1. So 1.9 raised to the power 1 over 4 minus 1. And we are getting 17.40%. It was 0.174, but I've converted it straight to percentage. So this is it. So we can do for the, okay, I think maybe for the 2.5 years, just to maintain it 2.5 years. But for this one, 1 plus this one give us 1.05. Right? Raised to the power 4 months. So 1 over, it can be 4 over 12. So 4 over 12 is giving us 0.333 going, right? Minus 1. So remember the n here is equal to 4 over 12, which is giving us 0.333. Right. So in total, we are getting 1.05 raised to the power 1 over 0.3333. We are getting 15.76%. So you see, it's very simple in here. Let's dive deeper. So that's what they solved here. So now, let's talk about measuring returns over time. So we are measuring the risk and returns, right? We are now coming to measure the holding period returns. The holding period return is calculated for each period. Arithmetic or geometric average is then called for. Is then called for the HPR. The following formula are used. So HPR, as we already know, is dividend plus capital gain over the beginning price, right? And then the HPR now can be dividend plus the selling price minus the cost price or the buying price or the bought price, all over the bought price, right? That's the HPR. So if you want the formula for calculating HPR, it's the same thing in here. So arithmetic average, which we've also solved it, the HPRs all over the number of years. And in geometric average too, we've also done this with 1 plus the HPR times 1 plus the HPR, or then raised to the power 1 over the number of years, then minus 1. So using the example, there's it. We've done this already. And using the example, there's it. So 1 plus this. So this is what they did, right? But when we use the same thing that we did, you will be arriving at here. I think when you use actually when it is 1.10 times 0.9 plus 1.20 plus raised to the power 1 over 4. So if it's 4 years, we will be arriving at the same thing, 0.0. Same thing. All right, risk and uncertainty. Risk is a quantity susceptible of measurement. A precise outcome may not be known, but the probability of a few that are most likely can be calculated. So risk is basically like, let's say, a constraint that will not let something happen, right? So if let's say you are going to return in an asset, if you are going to invest in an asset, risk is the probability that you might likely not get an interest, or let's say even your money fly back. That's the risk. So uncertainty means that there is not enough information to even narrow down the possibility. When a situation is not susceptible to measurement, economists call it Nietzschean uncertainty. COVID-19 has made risk riskier, but not a Nietzschean uncertainty. What then is risk? What then is risk? Risk is the uncertainty associated with the return on an investment that can be quantified in statistical terms. So meaning that for risk in finance, for example, we can measure them. Some people say we cannot measure risk, but some too are saying we can measure them. Right. So risk is not the same as uncertainty though. Variability of possible returns around the expected return risk. Sorry. Variability of possible returns around the expected return risk. Risk not risk is not exactly uncertainty. Risk can impact all components of return through fluctuations in income returns, price changes on investments, reinvestment rates of return and the like. So meaning that risk is not like affecting only one part of an investment. It can affect the income of the investment. It can also affect the price changes of the investment, and it can also affect the reinvestment rates of return. So the risk of an asset. Actual return on a security is made up of an expected return and an expected return. Sorry. Actual return on a security is made up of an expected return and an unexpected return. So meaning that whenever we are going to invest in an asset, we know normally we know the returns that we are going to get, and there's some returns so that we don't really expect to get, right? So there's one that we can calculate, which is the expected return, and the one that we cannot calculate is the unexpected return. The unexpected return can be, let's say, can be influenced by inflation. That will let the value of your investment decrease and the like. So, for example, what can you you could expect to make 15% return a year, but actual return will be 11%. This is because of inflation. This means that unexpected return is negative 4%, such that actual return is equal to unexpected return plus expected return. So it is given here. Such riskiness of return arise from economic, political, natural sources. Also, specific company events such as strikes and management weakness can cause uncertainty in the returns. that security returns are said to be random variables. Sources of risk. We have systematic risk and then asset-specific risk. So systematic risk affects many investments simultaneously, right? So let's bring it down to our normal home where the father is the breadwinner, right? So the father being breadwinner, when the father falls sick, it's a systematic risk because he wouldn't be able to go to work to bring money home. So this will affect the whole family. But if let's say one of the children falls sick, it will be like asset specific risk in the sense that it is only affecting the lady, the child that has fallen sick. You get it? Because the child is not really providing for the whole family. But the father being the one providing for the whole family will cause a systematic risk when when he is ill, right? So this is why we say that the systematic risk affects many returns simultaneously. Their impact is pervasive, and they can be currency risk, right? The rates that the currency will fluctuate, or deflate, or inflate. So inflation rate is here. The rates that inflation rates will increase, therefore increasing interest rate, because inflation rate is the one that causes interest rate to increase. So inflation rate, inflation, interest rate, political risk, unemployment rate, inequality, GDP, COVID-19, then asset specific risk affect only one or small number of investment returns. Poor management, it can be poor management, labor strikes, deterioration of products, and etc. I've explained this. So measuring of risk, right? We use variances and standard deviation to measure risk. But the real risk is the standard deviation. We will go deep down to go and talk about it. So average value, so variance is the average value of squared deviations from the mean. And it is a measure of volatility, right? And then the standard deviation is the square root of the variance. The greater the variance or standard deviation, the greater the dispersion in volatility. Meaning that when the variance is big, right, the higher the volatility, in the sense that so, and basically this is how variance is being calculated. Variance, we take that particular figure minus its mean. Let x bar be the mean, then square them. So basically, the x minus the mean is the deviation, right? Is the deviation. The x minus the mean is the deviation. So let's say x1. So plus x2 minus the same mean squared. So this is what we term as the one that is in the brackets without being squared. Is what we term as the deviation. You get it? All right. So I'm coming. Oh, so okay. So let me continue like this. So normally, variance is normally like this, indicated by the sign. So all of this, all over. For example, this is two. So this is two calculations. So let's see. Right. So whatever we will get for the variance, when we root it, when we find the square root of it, we are getting standard deviation. Let me use this example. Let me use some particular example so that we get it. So let's say we have 3, 6, 9, right? Total here 9, 18. Total here is 18. So if we want to find the mean is equal to the total over the number of days. So 18 all over 1, 2, 3. So 3. It is giving us 6, right? So variance, which is indicated like this, is equal to, we take the first one, which is 3, minus the mean is 6, then we square plus, now we take 6 minus the mean is 6, then we square plus, now we take 9 minus 6, the mean, and we square all over 3. So on the first side is giving us 3, negative 3. Negative 3 square is 9. So 9 plus, the second one is giving us 0. The third one is giving us 9 again. Right. So now we are getting 18. 9 plus 9, 18 divided by 3 is 6. So this is the variance. So when we find the variance, so now standard deviation, which is also indicated by this. Variance has this and the square, but standard deviation doesn't have square. All right, that one will be the root of 6. And then, or it can be 6 raised to the power half. And it's giving us 2.449. So you see, it is not difficult. So we'll dive in, we will solve some other questions and then. So that is what has been displayed here. Don't get confused. That's what I just did. That's what has been explained here. Don't worry. So we use this example, and then you can see from here the percentage rate of return 40, 10, 10, 20, right? So the mean for this, for example, is going to be 40 plus 10 plus 10 minus 20 divided by 4 because it is 1, 2, 3, 4 years. You get it? So that's what they did here. The mean is here. Deviations are basically the figure minus the mean. So deviation from the mean. So just 40 minus 10, which is the mean now, and then 10 minus 10, which is the mean. That's why they are getting all this here. So now when they square the mean, when they square the deviation, this is what they are getting. 900, 0, 900, right? So from there, we divide the square deviations by the n, is the number of years. That's why they are getting 1,800 by 4. That's what we just did. The same steps equal to 450, and then standard deviation will be the root of that one, and then they are getting this. So simple. That's what we just did. So this is also another example, right? This is also another example. By the same step, annual return is this, and the average, this is the mean. That's what you are seeing. This plus this plus this plus this, it is 4 years. So divided by 4 give us the mean. Deviation from the mean is basically the actual return minus the mean. So 0.15 minus 0.105. That's what we are getting. So we do all of them. we get deviation from the mean. When we square it, we are going to get square deviation. Now, when we add all of them, we are going to get a variance, right? So now when we get a variance, here they did the instead of n, instead of divided by n, they did 4 minus 1 for the n. This is because some of the investments are made during the end of the year and some are made during the beginning of the year. So if the question is given and an investment is being made at the end of the year, right, then it will be 4 minus 1, or it will be n minus 1. But if it is being made at the beginning of the year, then it's only n. This is because the first year will be in the calculations. By end of the year, the first year will not be part of the calculation. That's why we subtract it from it, right? So let's move on. So similar thing here. So individual securities. The characteristics of individual securities that are of interest are expected return, variance and standard deviation, covariance and correlation to another security or index, and etc. So let me stay here and then try and explain things here before we move on. Because if I don't explain, we move on, maybe one can get confused. So I'm going to explain what we are going to do before we get there. So first, let's tackle expected return. Expected return can also be ER. The expected return is basically the probability, right? Basically the probability times the rate of return. So if for example, we are given an example where the rate of return is, let's say, 20%, and then the probability is, let's say, 50%. Right. So if you want to get expected return, so okay, so this was rate of return, right? Right. If rate of return is based on probability is this. If you want to get expected return, it will be 0.2, which is the same as 20%, times 0.5, which is the same as 50%. Then now we are getting expected return to be 0.1. Right. Right. So that is it. You see how expected return is easy. So what we are going to do for expected return is that we multiply the probabilities by the rate of return, and we get expected return. Now, we also know how to solve for variance and standard deviation already, right? I just said that the variance is the square of the deviation from the mean. So x minus x bar squared. So let's say if it is x1, we do same for x1, we do same for x2, we do same for x3, x4, and we divide by the number of years. Right, the same thing is for the standard deviation. So for the covariance and correlation, what we are going to do is we are going to solve for the weight, right? So the weight is basically the product times the the weight is basically the product divided by the number of years. There's an example in this slide. We will use it to do that, and then correlation to is basically so covariance. It is the same as C, right? We are going to look for the product covariance. It's equal to, you are going to look for the product, right? Where the product is just, we are going to solve for product, right? Where the product is equal to the stock deviation, right, times the bond deviation, right, all over. No, it's not the stock. It's not all over. So basically, it is the stock deviation minus the bond deviation. Stock deviation times the bond deviation. So basically, if let's say for the deviation for stock we had 3, and then deviation for bond we are getting, let's say, 4. So 3 times 4, right? For the first part, for the first part of it, plus if the second set was, let's say, 1 times 2, the same thing. So 1, remember, 1 is for the first investment, and the 2 is for the second investment, right? And then for here, 3 is for the first investment, 4 is for the second investment. So let's say they are only 2, right? So we are going to get, let's say, here is 12, and here is 2. So we are getting 24, right? So if we want to get a covariance is equal to product over n. This is the number of years. So product, we have 24 over n is 2. So we will be getting 12. That is it for the covariance, right? We will solve a practical example to appreciate this. So product, we are going to multiply the deviations of we are going to multiply the deviations of the 2 assets. So this first one is for the first one, for the first investment, and this is for the second investment. So that's what we are going to do, right? And then now let's talk about correlation. So for the correlation, it is equal to, correlation is equal to the covariance for the first and second asset, right? All over the standard deviation of the first asset times the standard deviation of the second asset. I know that the formulas are becoming plenty, but keep practicing, keep watching the video, and you get it. So, for example, in the previous, we got the covariance to be 12, right? So let's just assume that after solving, the standard deviation was 3. The standard deviation for A was 3, and the standard deviation for B was, let's say, 2. So we are getting 12 over 6, which is equal to 2, right? So this will be our covariance if in case of. Just know that covariance is actually between 0 and 1 and the like. So, but I'm just trying to do some examples. Right? Hey, I'm talking about correlation. Sorry. Correlation is not that high to be true, but I'm just trying to use this example. And then when so basically I'm coming. This means that A and B are positively correlated. So when let's say an investment is positively correlated, but what it means is that when the first one is doing well, the second one too is doing well, right? So basically, it means that they are all moving in the same direction. So let's say you've invested in Bitcoin and you are investing also in, let's say, Ethereum, right? They are all cryptocurrencies, right? And it is very possible that when Bitcoin moves up, Ethereum will also go up. And when Bitcoin falls, Ethereum will also fall, right? But when they are negatively correlated, what it means is that when one is moving up, one is coming down. And when one is coming down, one is moving up. And as a finance student or as an investor, that is the kind of investment you're looking for. So you are going to check the risk that is associated with them, so that when one is moving up and one is coming down, the difference doesn't really look big and it will still be advantageous for you. Right? If you invest in an asset that moves together, right? In the time that they are all bad, in the time that one is bad, they are all bad, meaning that you will be facing some kind of trauma. You get it? But if one is bad and one is going well, you have some kind of security. That's why when you have two girls or three or four girls, when one is misbehaving, you still have other ones. Get it? Huh. So let's move on, and then I'm sure we'll be able to solve some questions in this and then clarify everything. Please don't get confused, okay? Seeing this, initially when I saw this, I became confused, but let me explain this, right? It's not difficult. So now, expected return and standard deviation. So this is a question that we've been given. Suppose there is a 50% chance that the return on project A will be 10%, and there is another 50% chance that it will be 30%, right? What are the expected return and standard deviation on the project, right? So now the expected return of A, which is ER, is given as the weighted average of the possible outcome. So expected return of A, remember expected return, I told you that expected return is equal to the return on the asset times the probability, right? The return on the asset times the probability. So that's what we are saying. Expected return, right, is the return of the first one was 10%, and the probability of that return happening is 50%. That's what we are getting here. Plus the probability of the second one, which is 250%, times the return, which is 30%. That's what we are getting. So the expected return on this asset is like at least 20%. That's what it means, is 20%. So if we want to get a standard deviation, we have to find the mean. So we find so this is a small table we are doing. We have in here. Let me bring my marker. So now this is return 1 and this is return 2, right? They all have the same probabilities. Right. Now, if we want to get a deviation, right? If we want to get a deviation, we will add the returns, right? Which is 1 plus 0.1, sorry. 0.3. Right, this is giving us 4. When we divide it by 2, we are getting a mean of we are getting a mean of 0.2, right? So now let's find deviation. The deviation now is 1 minus the mean. Sorry. 1 minus the mean. The mean here is 0.02. 0.1, sorry. The mean here is 0.2, sorry. Right, so in total I'm getting negative 1. 0.4. That's what we are seeing here. We do the same thing. 0.3 minus 0.2. This is given as 0.1. Right. That's why we are getting this. And when we square them, when we square this, when we square the deviations, we are getting 0.01, 0.01. We get it. So now, if we want to get the weighted to this thing, remember we are going to multiply the probabilities by the squared deviation. I'm coming. In 2 minutes. All right. So now this is what we have for the square deviation. Here. So now the square deviation, when we add all of them, when we add them, we are getting our variance, right? When we square them and we add them, right, we are getting our variance. So now when we find the square root of the variance, we are getting the standard deviation. So let me do it this way. Let me do it this way. So basically, it will be 0.1 minus 0.2, which is the mean squared, plus bracket 0.7 minus 0.2 squared. over n, which is 2, right? So now with this, we are getting all right. So negative 1 squared negative 1 and negative 0.1, sorry, 0.01 plus, so I'm getting 0.02 all over 2. And I'm getting 0.01, right? This is the variance. So now if I find the root of the variance, all right, I'm getting 0.1. That is the standard deviation, right? So that's what they did here, but they just use a different approach. All right, so let me know. So there's an example here. Consider the following two risky assets board. There is a 1/3% chance of each state of the economy, and the only assets are stock fund and bond fund. Now, let's solve for the expected return, right? So basically, what we are seeing here, standard deviation is the risk, and then the expected returns are these, right? So we are going to solve for all of these, and then yeah, we're going to solve for this, and then deal with it. So we know how. So okay, so let's do it one by one, right? For here, we are seeing square deviation, right? Square deviation. This square deviation is for the return for the stock fund, right? So remember what we are going to do here. Remember that I made mention earlier in this video that we need to find the expected return, right? So expected return is basically the probability times the rate of return. The probability times the rate of return. So that's what we are going to do. So if we want to get the expected return for stock fund, now probability that we are getting here in the question was 1/3, right? So 1/3 is going to multiply all of this with rate of return. And then let's put that down. So negative 0.07 plus 0.12 plus 0.28. In total, we are getting around 6.99, 10.99 something something, 10.9 something something, which is approximately 11%. Oh, sorry. So 0.1099, so, and so, right? And when we convert it, we are getting like 11%. Let's say approximately 11%. That's what we are seeing here, right? That's what we are seeing. So when we do the same thing for the bonds, we are going to get approximately this, right? Mind you that when we, from what we are seeing here, right, when we add all of these and then divide it by 3, right, we are going to get 11%. But for example, for stock, we are going to get 11%, and for bond, we are going to get 7%. But let's ignore. So now, let's go to variance. I even promised to do 2 sessions on the stocks and bonds and capital, but okay, I'll do it very soon. So now let's go to the variance. The variance is basically how far the distance are from the mean, which is the rate of return are from the mean, right? So now let's solve for the variance. So variance, for example, if we want to solve for variance, we first need to compute for the mean, right? The mean is basically re-adding all these and then divided by the number of scenarios. We have recession scenario, normal scenario, and then boom scenario. So we have 3 scenarios. So that's what we are going to do. So negative, let me just 0.07 plus 0.12 plus 0. Remember, this is negative 0.17 divided by 3. So when we do that, we are getting 11. That is our mean, right, for the stock. You get it? That's our mean for the stock. Then let me write it here. 11%. Right. So now if we want to solve for the variance, remember the variance is x minus x bar, which is the mean, all squared plus so we can do that. So negative 0.07 plus minus the mean, which is 11%, squared plus the second one says 0.12 minus 0.11 all squared plus 0.28 minus 0.11 squared, right? So we are getting 0.03 0.0324 plus 0.0001 plus, so you see, now when we add all of them, we add all these three, we are getting, sorry, you have to divide all of these by 3. So divided by 3. Now when we do that, we are getting 0.0205. Right. So now we can see that 0.0324, this one, is here, square deviation, deviation squared, this is also here. So when we do same 2 for this, we are going to attain the same level of this thing, right? So now we had 0.0205 as the variance, and the standard deviation is the square root of the variance, so 0.0205. We are getting 0.1432, so it is also equal to 14.32%. That's how they are getting this here. When we do the same thing for bonds, we can try that one. We arrive at the same thing here. Here. Right. So find for the mean. After finding for the mean, then you find for the variance. When you are done, then you solve for the standard deviation. All right. So now let's move on. All right. So that's what they've done here. That's what they've done. We've done all these. So we've done all these. Done all these. Now I want to talk about the covariance. So now let's deal with the covariance here. Where covariance is basically this. Alright, so let's see how they got this. So for them getting this, what they did was that they found a product for the covariance and they divided it by the number of scenarios. Right, so it was that this times this, and they had this. This times this, and they had this. This times this. So boom, which is a 17% times the negative 10% is here. So now what they are going, what they did was they added all of these. So adding all of them, negative 0.0180 plus 0 is 0 plus negative 0.01. I'm getting negative 0.035. When divided by the possible scenarios, which is 3, we are getting 0.011666. That's why it's also the same as 0.01175 negative. So easy. So as I said earlier, I said that the covariance is basically the you first finding the product. When you find the product, then you divide it by the number of scenarios or the number of years or whatsoever it is, right? So we can also do it this way. See, okay, it's the same thing. So basically, we can let's look at it here. Okay, here was the squared deviations. All right. So if you remember, if you pause this video and go back, you see that we solved for squared deviations, right? So if you don't square it, that's where you get the deviations instead, right? You get a deviation. So the deviation is basically like this. So the deviation is basically like this: x minus x bar, right? So if for the first scenario, x1 minus x bar, that's it. This is it for the deviation. But if you want to solve for variance, that's when you square it. If only deviation, standard deviation, like only deviation, that's when you do what? You just leave it like this. So that's what they use for this. All right, let's move on. Remember to pause and like the video, please. So now, if we are now here at correlation between returns. I remember in class when I saw this, I became confused. I was like, hey, what is this? What at all is this? You can see a whole lot of formulas, but it's easy. We're going to understand this. I'm coming. Let me continue. So now consider two companies, X and Y, with expected return Now we know how to solve for expected return, right? All right. So with expected return, it is Rx and Ry. Expected return of X and expected return of Y. We may want to know what happens to Y if we knew that X has done well, or the vice versa. That's what we term as the correlation. Right? What will happen to X when something also happens to Y? So the coefficient of correlation between the returns of X and Y measures the extent to which their returns move together. Right? So this is the formula for solving for the correlation. Rxy is equal to the summation of whatever. Basically, this is the covariance all over the standard deviation. So this is what I just did before we came here. So for this formula, it's the same as this covariance of A and B all over standard deviation of A and standard deviation of B. So here they will multiply, right? Remember the covariance, right? Which was the product divided by either the number of years or the number of scenarios, right? So that's the same thing in here, but they've let it look like it's scary or it's fancy. That's basically it here, right? So it can be shown that -1, it can be shown that correlation is either greater than or equal to -1, but less than or equal to 1. If correlation is greater than 0, that is, it is positive. It means that the two returns tend to move in the same direction. That is, if X has gone up, then Y too has, and then vice versa. The higher the value of the correlation, the higher the degree to which the two move together. If the correlation is +1, then it means that Y and X are perfectly positive correlated, meaning that they move in the same direction. So mean that their returns move up or down the same proportion, right? And this is not what we as investors are looking for. If they all move together, it means that we have all our eggs in one basket. If that basket falls, all our BBR, right? So we don't want that. So let's dive in and then see what we want. So that's the covariance thing here, right? In what we solved, the covariance, we had 0.07. Where is it? All right. We had negative 0.117. That's it here, right? So you see, we are using the same thing here. Now, the standard deviation for A and the standard deviation for B at the same B, this is the same thing. I will follow the same procedure and then we arrive here. So now, let's talk about coefficient of variation. So currently, this is what we need under correlation. I'm sure I will do a tutorial on it. So coefficient of variation. So coefficient of variation is the variation. A coefficient of variation is the ratio of the standard deviation divided by the return on the asset. So the higher the coefficient of variation, the riskier the investment from the riskier the investment. So the higher the coefficient of variation, meaning that the investment is more volatile and it is risky. Right? So from our example, this is what they had, but this shouldn't be it. Normally, the coefficient of variation is we use it to compare two assets, right? We use it to compare two assets. So now, what we are supposed to do is we are supposed to check for the coefficient of variance for what do we say, example? For stock. Then when we are done, then we check for the coefficient of variation for bonds, right? And then we check. You see, the higher the coefficient, the lower the higher the risk. So meaning that here they are telling us that the lower the ratio, it so mean that if the ratio is small, then that investment is better. Now let's check for let's solve for the coefficient of variation. So coefficient of variation for let's say stock, right? The formula is basically standard deviation all over the mean. So standard deviation all over the mean, right? So for stock, our standard deviation was, you can pause the video and then go back. It was around 0.1423, and then the mean was 0.11. When we do this, we are getting 1.302, right? So if we check for bonds, right? If we check for bonds, then this thing is equal to CV bonds. This is equal to, the standard deviation for bonds was 0.082 or so, divided by the mean for the bonds was 0.07, which is equal to 1.171. So we can see that this is lesser than this. So meaning that the bonds is less riskier as compared to the stock. And it is true, in the stock market, price is very volatile than bonds. So this is actually true, right? I tried adding this and then this to see whether I'll get this. I had this with just some slight deviation, but I don't know. So I don't know what they mean by this. So let's move on. So risk diversification. Risk diversification is a strategy designed to reduce risk by spreading portfolio across many investments. You see? So basically, that's the main reason why we are learning this topic, risk and return. We want to diversify our investment so that we wouldn't really be at loss, right? So there are some kind of risks that are associated with our investments. We have unique risk, and then we also have market risk. So for unique risk, these are risk factors affecting only that firm, and also called diversifiable risk. So these are some kind of risk you can run away from. You get it? It only affects a particular firm. Right. And then we also have market risk. So this is economy-wide source of risk. That is it affects the overall stock market. So it's also called a systematic risk, right? So while risk diversification eliminates the unique risk of individual security, one cannot eliminate the market risk. Right? So meaning that for unique risk, you can run away from it, but market risk, you cannot. It's more or less like a constant something. So the risks that affect the entire market or stock. So for a diversified portfolio, only market risk matters. We don't think about unique risk. When one discusses securities investment or investors, it is assumed that the security is held in a diversified portfolio, and the relevant risk is market risk, right? So what this means is that whenever we are planning on any investment, most often what we should be thinking about is market risk, because for that one we can't flee from it. So what are we to do to minimize that risk? So portfolio diversification works because price of different stocks do not move exactly together or are perfectly correlated, meaning that stocks are not perfectly correlated. Price of stocks are not perfectly correlated. Diversification works best, or the risk reducing effects of diversification work best when stock returns are negatively correlated. This means that when one stock is going up, the other stock is coming down. That is where diversification works best. So diversification reduces the variability of returns on the portfolio compared to the average variability of individual stocks, right? So we are the same formula here again. This is the same thing again. I've explained this already. So if correlation is less than 0, it means that the two returns tend to move in opposite direction. That is, if X has gone up, then Y has gone down, and the vice versa, or vice versa. The smaller the value of correlation, the higher the degree to which the two move in opposite direction. If correlation is equal to 0, it means that the two returns are not correlated in any way. That if we knew that X has gone up, we cannot infer the direction in which Y has gone. And if correlation is equal to -1, then X and Y are perfectly negatively correlated, meaning that their returns move in opposite direction by the same proportion. So these are here. So most often this is where people also get confused initially when they were teaching in class. I also got confused here, but I realized that this is easy, right? So remember that okay, so this is for expected return for P. That's the expected return, right? For the portfolio, that's the expected return P. So expected return P for the portfolio is equal to XA times ERA plus XD plus ERB, where XA is the portion of capital that has been invested in asset A, right? And then ERA is the expected return of asset A. You get it? And then XD is the portion of capital that has been invested in asset B. And then ER is the expected return of asset B. You get it? So in a question, for example, they will give us the portion of capital that has been invested in asset A, and then the expected return that we want or we're expecting to get in asset A. and then the same. And here is another thing where it talks about variance of portfolio. So this variance of portfolio, VP, measures the volatility of the portfolio, how it responds, how it moves. You get it? So for that one, it is here is the portion, the same thing, the portion of the capital or the portion of the money that has been invested in asset A times the standard deviation of asset A squared plus the portion that has been invested in plus the portion that has been invested in asset B times its standard deviation squared plus 2 times all of them. So times 2 times the portion we've invested in asset A, portion we've invested in asset B, standard deviation of A, standard deviation of B, times its expected return, right? Times its expected return. So basically, and okay, this sorry, not it's they are correlated expected return, right? They are correlated expected return. Sorry. So basically, look at it. This is what I'm trying to say. It makes them easy. So okay. So look at it. Look at this. How to get this very simple. Look at this. And then look at this. Can't you see they look alike? Right? Getting this simple, get it in mind that first you are adding the squares of them. To mean that the portion you are investing plus the standard deviation squared plus the portion you are investing in B plus standard deviation squared. Right? You're adding them, then now plus now the same thing 2 times all of whatever is in A. So this time around, when you're able to get the first one, right? Now you just multiply 2 times or whatever is in the first line here, the first side here. You're multiplying 2 times all of this. Now times the correlated, this time around, you're adding the correlated expected return to it. So you're multiplying 2 times all of them. You get it? So this is easy, like it's easy to remember when you just if you think that there will be a problem, just remember the first one. Like remember the first one, portion and standard deviation of A plus A all squared plus portion of the capital that will be invested in as a B times its standard deviation, right? All squared. Then now you know that it's now 2 times the portion of A times the portion of B times standard deviation of A and standard deviation of B times the correlated probability or the correlated expected return. Then you add that. So once you're able to get this first one, right, now you know that you are multiplying 2 by all of these. It makes it easier. Look at this example here. Suppose a project has an expected return of 20% and a standard deviation of 10%. Okay, so suppose project A has an expected return of 20 and a standard deviation of 10. Whilst project B has an expected return of 8% and a standard deviation of 2.5%. Suppose you invest 1.1/3 of your money in A and 2/3 in B. What is your expected return and risk if correlation coefficient of their returns is 0.4? Now, expected return is the portion of A times the expected return. The expected return on the portfolio is the portion of the money that has been invested in A times the portion A, no, and the expected return of A, right? So now here will be they've invested 1/3. Okay, that's it here. 1/3 and then 2/3 here. Right. So now 1/3 and its expected return is what? 20%. It's 20. That's a plus now 2/3. Then its expected return is what? 8%. Now this is the expected return on the portfolio that we are wishing to get, right? Now, if we want to solve for the uh, variance of the portfolio, how volatile it is. Now let's solve for that here. Right. So it is basically the portion we are spending on a 1/3, right, times its standard deviation. A standard deviation is 2.5%. So 0. Okay, let me just bring the 2.5% so that it saves space. All right, 2.5%. All squared plus 2/3. That's what has been invested in B times its standard deviation. The standard deviation here, where is it? Okay, the first one standard deviation is 10%. So the second one is 2.5. So here is 10%. Sorry. Right. So now this one to squared. Now, if you remember, just once you remember the first one, okay. Now just bring 2, multiply all of them. This right, all of them, and 10%, all of them. You come and then this the correlation thing. So this is 40%. Right. So if you're able to get the first part, that's all. Now what you're going to do is you multiply all of them, right? All of them. That's it. This is how this thing will look like, right? I don't want to waste much time. So once you input this on the calculator, you're going to get your answer. So now, right, when you do that, you are going to get for the variance, because VP is the variance for the portfolio. So if you want the standard deviation of the portfolio, what you are going to do now is, you know already, you find the square root of the variance, then you get your standard deviation for the portfolio. So that's it here. So you see they did the same thing as in the slide. So if you don't want to really keep this and you think this is plain, just keep the first side in your head, right? That the portion times the standard deviation squared plus the portion times standard deviation squared when you are done. Okay, if you remember the first part, the second part, just bring 2, then multiply everything times the expected correlated distance. Then you're done. All right, so weighted average risk reduction. Risk reduction means reducing risk below the weighted average of the risk. Risk reduction means reducing risk below the weighted average of the risk of the securities in the portfolio. Total risk, which is both systematic and non-systematic risk. Risk reduction comes about because stocks are not perfectly positively correlated. As the returns on one rises, the return on the others does not as much. On the other hand, as the return on one falls, the return on the other does not fall as much. That by investing in more than one stock, the portfolio achieves a moderate effect. All your eggs are no more in one basket. Why does risk reduction appear to stop at some point? So we have the systematic and unsystematic. Systematic risk is also called market risk, bedrock risk, or undiversifiable risk. So meaning that like you can't even fly away from it. So unsystematic risk, unsystematic risk is also called unique risk, idiosyncratic risk, and then diversifiable risk. So now look at it. You see that I told you that earlier on the standard deviation is the risk. The standard deviations are the risk. So now we are seeing that note that stocks have a higher expected return than bonds. Let us turn now to risk return trade-off of a portfolio. That is 50% invested in bonds and 50% invested in stocks, right? So now we are investing 50% in stocks and bonds. Now let's see how it will affect our risk. Just note that when you are investing all your money in stocks, your risk is 14.3%, and your expected return, your average expected return is 11%. And when you are investing all the money, if it was 100%, if you are investing all in bonds, your risk is 8.2, and then your expected return is 7%. Now we want to now solve for we want to diversify our this thing by not investing all in stocks and all in bonds. We are coming to distribute and then save 50% in bonds and 50% in stocks. Let's see what happens to our portfolio. So at the end of it all, we are seeing that now our risk has been reduced up to 3.08%, and then our return has now been 9.0%. You get it? So now let's see what caused that. So what's causing this is that you find 50% of the first recession, 50% times 7% plus 50% times the bond one, and so the bond one to 70%. So that's what we did here. So weight of a bond. Okay, the rate of return on the portfolio is the weighted average of the returns on the stocks and the bonds in the portfolio, right? So when you multiply the amount that you are investing in an asset to this thing, you are getting the weight. So where now we are having 50% times, which is 50% is the amount you are investing, and then 7% is item, right? So negative 7% as specific. So this is what we did, and we did it for bonds plus stock, and we had 5%, right? So we did the same thing for the second one. We had 9.5, which is 50% times 12% plus 50% times 7%. The same thing for the third one. The same. Then we had this, right? So remember, if we want to get this expected return, it is the portion that we are investing, right, times the rate of return, right? So now it is 50%. Right? So remember that for our in the beginning we used probability of 1/3, right? So we use the same probability that we did for this, which we had 11%. So the same. So we add all the portfolios, they multiply it by 1/3, then we get 9. That's it here. So now let's talk about the deviation, the standard deviations. So when we solve for the variance again, you can try your hands on it. Remember the variance, right? We find the mean, then we subtract the portfolio from the mean, portfolio from the mean, portfolio from the mean. Then we square them, and then now we divide it by 3. When we divide it by 3, now we get a variance. Then now when we find the square root of the variance, we get the standard deviation, right? Square root of variance, we are supposed to get the standard deviation. Yes. All right. So basically, that's it. I'm sure you like. I'm not really solving the other ones because we've solved similar stuff, and you can just try your hands and do the same thing so that it will enhance your understanding. That's why I've not really solved, and I'm rather talking here. So just do the same thing, and you understand it. So yes. So as I was saying that at the end of it, now our risk is now 0.08%, and our return is now 9%. We can see that now our return is higher than the risk. So basically, what it means is that if you are investing or if you are going to invest in some assets in their correlation, it's not really giving you a better risk, a better return over the risk. It's not advisable. You can see that prior, all the returns were lower than the risk. Here is 11%, the risk was 14%. Here was 7%, the risk is 8%. But now here is 9%, and the risk is only 3%, which means that when you lose, let's say you are investing 100 cedis and you lose like 3 cedis, right? But when you win, you are winning like 9 cedis or so. You get it? That's what it means in here. So measuring risk, market portfolio of all assets in the economy. In practice, A broad stock market index is used to present the market. It's used to represent the market. Beta, sensitivity of a stock return to the return on the market portfolio. So beta is like the slope of the market, right? So which remember it was x1 minus x2 over y1 minus y2, something like that. So total rate is equal to diversifiable risk plus market risk. Market risk is measured by beta, the sensitivity of the market changes. So this is beta, standard deviation of the market over the variance of it. So it's also the same as the covariance of R1 market risk all over the standard deviation of the market risk. They were seen. So the first side is the covariance between the stock returns and the market. Stock returns and the market returns. Whilst the downside is the denominator is the variance of returns on the market. So diversification, variability from unique risk, but not market risk. Diversification decreases variability from unique risk. So meaning that when you are trying to diversify your portfolio, it doesn't like pull you away from market risk. Market risk is constant. So we can't run away from it. The beta of a portfolio will be an average of the betas of the securities in the portfolio. If you own all Ghana Stock Exchange Composite Index stocks, you would have an average beta of 1.0. The security market line. A plot of expected rate of return of varied risk, which is beta, portfolios is called the security market line. According to CAPM, which is capital asset pricing model, that's what it means. It is expected rate of return of all securities and all portfolios lie on this line. So they all lie on the security line. The required risk premium for any investment is given by the security market line. A stock rate, a given beta that is expected to earn a return higher than that on the security market line will be purchased by investors, bidding up the stock price and lowering the expected rate of return to the security market line. Investors keep expected returns on the security market line. The security market line is the risk-free trade-off of investors. The CAPM states that the expected risk premium on an investment should be proportional to its beta. So this is the expected risk is equal to the risk-free plus the beta into brackets the market risk minus the risk-free, right? So basically, if the beta is 0, then R is equal to risk-free, right? And when beta is 1, R is equal to market risk. I think they'll say it here. The market portfolios of all assets in the economy practice run. Total risk measured by the standard deviation is the sum of systematic risk and the unsystematic risk. Diversification reduces unsystematic risk and may eliminate it all together for a well-diversified portfolio. The market portfolio is well-diversified portfolio. It's a well-diversified portfolio. In the marketplace, only market risk is prized or rewarded. You are not rewarding for bearing unnecessary risk. Measuring the market risk of a portfolio or a security amounts to measuring the sensitivity of its returns to changes in returns on the market portfolio. This is called the beta of the security or portfolio. It is given as the slope of the line plotting returns of the security on the vertical axis and against the returns on the market. This is how we do. Relationship between risk and expected return CAPM. So RM is equal to RF, which is risk-free, plus market risk premium. So market risk premium is basically the RM minus RF. That's what we are seeing here. Where RM is market risk and RF is risk-free. This applies to individual securities held within more diversified portfolio. So that's it here. Now, relationship between risk and return. So relationship risk and return, for example, have it has an upward sloping, meaning that the higher your risk, the higher your return, and the lower your risk, the lower your return. It is more or less like the law of supply, right? So this is what we are seeing here. You can see that you can see it's an upward sloping, and the higher it goes, the higher the return, and the higher the risk too. So the same thing here. Same thing here. So now here they are solving using the formula, which is R risk is equal to RF risk free, right, plus the beta times the market risk minus the risk free. And it had this 13.5%. All right, so this ends our session. If there's anything you didn't understand, you can draw my attention to it. And hey, wow, this session is lengthy. Wow. Hey, taking the 2 hours. Wow. So all right, let me upload this. If you have any question, you can put it in the comment section and I'll come and reply and answer you there. Thank you very much for your time. Goodbye. Please don't forget to like and subscribe to this channel.